It's Stephen Cruz here. I'm a mortgage advisor with Verico iMortgage Solutions and the president of BNI Rocky Mountain Thunder. And today I have Randy McCord with me, and he wants to tell us a little bit of information about his business. But first of all, Randy, why don't you tell us a little bit about yourself?
Well, thanks, Steve. I'm actually one of the founders of National Best Financial Network, and we're an independent life insurance brokerage. We provide Canadians with independent financial advice. We have about 300 advisors across Canada, and our job is to act as a broker for financial services for Canadian families and business. Today, though, what I want to focus on is risk management for business. That's been my specialty over the last number of years. I've been licensed for approximately 8 years. Prior to that, I was in the transportation business for 25 years. And I've been a lifelong investor, so I've had an interest in financial services in my own private life for a long time, and now I've just made a career out of it.
Sounds good. Why don't you tell us about risk management for business then?
Well, risk management for business really represents trying to protect the assets or the employees of a company, whether you're a sole proprietor or whether you have an incorporated company and have employees. There are lots of interesting strategies that we can use to help protect the corporation or the employees themselves. And also the nice thing about life insurance is it provides some opportunities for wealth, the growth of wealth and the protection of that wealth as the corporation continues in business. So in the world of National Best, we have a variety of different divisions, and National Best Business Solutions is the division that sort of focuses on assisting companies, businesses. Today, I'm going to speak specifically about one strategy that many people overlook, simply because it involves a life insurance product. So what I'm going to do is I want to explain a strategy called an estate transfer with cash payout strategy. And so this quick slide here just sort of outlines what the issue is and what the strategy and the product is that we use to solve the problem. So the question that we have is how to invest earnings in a corporation and transfer it to the next generation tax efficiently. In fact, we're also going to include creating retirement income with that strategy. And so what is the strategy? Well, it involves purchasing a participating whole life policy, but it's purchased by the company or the corporation, not by the individual. What does it do? Well, it provides insurance coverage while building tax-deferred cash value and dividends inside of the policy, and we'll explain that later. The advantage is that it provides retirement income, as I mentioned, to shareholders, and it transfers value to the next generation in a very tax-efficient manner. So we're going to talk about what this strategy actually represents and why would a business owner actually use it. So the corporate estate transfer with cash withdrawal, really what it is it's meant for someone like Jane Doe. Jane Doe is the CEO of Doe Corporation, and she may have a number of employees. She's been in business for a number of years. She has a stable business, although she would like to grow it, as most business owners do. She's making money and she's profitable. So she's been in business for a number of years, typically more than 5 years. She's 40 years old, so she's in the prime of her life, both from a family standpoint and a business standpoint. The corporation makes $30,000 a year that they don't need to spend operationally and that they don't need to pay out in terms of salary to any of the employees or to Jane or her family. They're living a perfectly good lifestyle, and to take the money out would mean that it's simply taxed in the hands of the employees or Jane, the shareholder. So it makes more sense from a tax standpoint simply to leave the money inside the corporation. Jane would like to retire at age 65, And this strategy is built around allowing her to do just that. Now, she wants to maintain the corporation, and we are in agreement with that because the corporation is useful for a number of reasons. Number one, it's useful for tax purposes. Even at the time of retirement, it can mean that Jane can income split with other shareholders, i.e. her husband, or perhaps even her children. And number two, for estate planning purposes. So for instance, if Jane were to pass away at some point, remember this is a life insurance plan, so the life insurance proceeds would flow to the corporation into what's called their capital dividend account and could then be distributed to shareholders, i.e. Joe's son and daughter's account. These benefits would be tax-free. Again, a perfectly good reason to maintain the corporation and have the corporation own the policy. So, corporate estate transfer with cash withdrawal. If the excess earnings that are in the corporation are invested in stocks, bonds, mutual funds, segregated funds, real estate, or just about any other sort of investment that are typical, the problem is passive income is taxed at a very high rate for corporations in Canada. And in fact, it's taxed at 44.67% in Alberta. Well, that's a pretty hefty tax on income that's made inside of a corporate structure. The reason the government does this is simply because the corporate structure wasn't made or wasn't introduced by the government in order for business owners to shelter investments. It was meant for them to hire employees and to buy inventory and to help drive the economy. So they were never intended for business owners to invest in passive income, and that's why it's taxed so heavily. So the question is there a tax shelter for retained earnings that will earn a reasonable return? So is there some kind of tax-deferred structure where we could take these retained earnings, there's $30,000 a year that Jane has, and invest it and make a reasonable rate of return? And in fact, corporate estate transfer with cash withdrawal plan is exactly that. It involves the corporation purchasing a participating whole life policy. Now, the dividends are paid annually on this policy. That represents the investment portion. The insurance company, when someone purchases this policy, the insurance company will pay them dividends or a share of the profit in the insurance company every year. What are these returns like? Well, they can be quite lucrative. We know that a couple of companies are paying in the 8 to 10% range over the last 20 to 30 years, even through some of the big recessions and downturns. We've seen pretty healthy rates of return. So not a bad place to invest. Second of all, the dividends are based on how much insurance is purchased. So it's not really based on investing in a particular stock or bond or some other form of typical investment. It's really based on how much insurance you have, because that's how the insurance company calculates how much they pay these participating policyholders in terms of the additional profit made. So the Doe Corporation becomes the owner and the beneficiary of the participating whole life policy. Of course, the life insured is Jane Doe herself. She's the one whose life is insured. She's the key employee of the corporation, and so the insurance company typically would not have a problem insuring Jane simply because she's important to the corp. So what we would do is, instead of trying to figure out how much insurance Jane should have as a key member of Doe Corporation, we would just solve for how much insurance we could get for putting away $30,000 a year. In other words, $2,500 per month into the policy. It turns out that that would provide $625,804 of basic life insurance for Doe Corporation should Jane ever pass away prematurely. Well, what does this mean in the long run? Well, what it means is that the dividends, as we mentioned, will be paid annually and will be added to the cash value inside of the insurance contract. We'll also buy additional insurance every year with those dividends. So why are we buying additional insurance? Well, if you recall, the dividends that we get are based on how much insurance we have. So if Doe Corporation sets up the plan so that it buys additional insurance on Jane every year, that means that the next year the dividends will be greater. And our job here is to try and build up cash value inside of this policy that can be used later in life. So we pay all of the premiums in 20 years. It's simply set up this way so that there's an end point of having to pay the premiums. This means that when Jane is 60 years old and thinking about perhaps retiring and selling the company, the premiums no longer have to be paid. The policy will stand on its own without ever having to have any other input, external input in terms of premium payments. One additional option that's provided by some insurance companies is the ability to purchase additional insurance with every single premium payment. So not only are we going to buy additional insurance with that annual dividend, that is the paid up additional insurance option, but we're going to implement the additional deposit option, which will provide us with a little bit more insurance every single month for that $2,500 that we're putting into Jane's policy. This means we'll maximize the cash value inside of that policy, inside the whole life policy, owned again by Jane Doe Corporation. Remember, all of the dividends and all of the cash that is accruing inside of this policy, which is inside of Jane Doe Corporation, is tax deferred. There's no tax payable on the accumulation of these dividends and this cash value. That's the key to this strategy. So let's just look at year 10 when Jane is age 50. We will see that the total cash value in the account is about $190,000. Quite nice, quite nice. The total death benefit has also grown from $600,000 to $1.1 million. Now, why is this a good thing? Well, it's a good thing for a number of different reasons. First of all, it's a hedge against inflation. Over time, the value of Jane to the corporation is probably increasing. Not to mention that Jane's beneficiaries also will potentially need more money as time goes on, as inflation eats away at the value of the benefit. But further to that, the additional insurance, as we know, increases our dividend. So as we increase the amount of insurance that's purchased, so goes our dividend, that thing that is accumulating extra cash inside of the policy. Let's just say, though, at some point, Jane says, well, you know what? Jane Doe Corporation requires some money, and we'd like to lease some equipment. Is there any way that we could access the $190,000? And sure enough, the insurance company is happy to provide what's called a policy loan. So Jane Doe Corporation could, in fact, borrow out up to 90% of the cash value, and without qualifying, which is really a key. It's not like borrowing from the bank where you have to have financials and prove income and revenue and be beholden to the bank's particular structure in terms of a loan. In this case, the insurance company says, no problem, we will lend you $170,000 against this cash value, and you can pay it back at your leisure. Pay it back in any way that you so choose. In fact, it may not even be necessary to pay it back, depending on circumstance. However, in our example here, we do want Jane to pay it back because we do want the full benefit of the cash value at the time of retirement. But she could pull out the $170,000, pay it back over 3 or 4 years, treat it like a lease payment, and in fact could make use of the money along the way. This is an extra benefit. It's a fantastic benefit, mostly because, this is the important part, Jane Doe Corporation would still receive the annual dividend even if they had taken out the policy loan. So even though they removed $170,000 from the cash value, next year they would still receive the annual dividend, which is so important to the growth of the funds. Now, why is this? Well, as we've mentioned, it's the amount of life insurance that determines the dividend, not the cash value inside of the contract. This is a key feature of this particular strategy, that the corporation gets to have its cake and eat it too. It actually gets to borrow the money and make use of it, and at the same time, still receive the annual dividend. This is one of the powerful parts of the strategy. However, let's look onward and say that at age 65, Jane actually retires. We might even say that, you know what, she's actually prepared her company for sale at around age 60, and at age 65 actually sold the company. But she still has all of these retained earnings inside of a corporation, and we're going to describe that corporate structure a bit later. But we assume she still has all of the monies that have been accumulated in the policy over time when she retires at age 65. Well, she can go to the insurance company and say, Mr. Insurance Company, I've bought all of this additional insurance over this last 20, 25 years, but I don't think I really require it anymore. Is there any way that I could create an income and give you back a lot of this insurance that I no longer require? Turns out that the insurance company is happy to do this for Jane. And in fact, in this particular scenario, that would create an annual income for Jane of $71,578 over 20 years. A pretty darn good addition to her other retirement income from other sources. Fantastic way in which to get the money out of the corporation in a tax-efficient manner. I don't want to go into the tax details now. That's a little bit too complicated. But if you take this strategy to an accountant who understands it, they will explain to you the tax advantages of moving the money out of the corporation in this fashion. In fact, that $71,000 could be split between Jane and her husband, paid out as dividends, and there could be virtually no tax paid on it in a province like Alberta's. So at age 86, Jane passes away. There's still $500,000 of value inside of that account because of the insurance portion. So if Jane passes away, there's still $560,000 insurance that can now pass tax-free to the shareholders, who again could be Jane's son and daughter. So there's still the ability to transfer the estate, or what's left of the estate, to the beneficiaries in a tax-free way. One more wonderful aspect to this particular strategy. Certainly if Jane passed away at a younger age, there would be even more money here for her husband or her beneficiaries. So the shareholders will benefit tax-free from Jane's death in this case. And again, it's a great estate transfer tool. So, all in all, what we're saying is if Jane has an operating corporation, and the operating corporation is what produces the business or the revenue, the active business, It's the entity that's creating this additional $30,000. One thing we want to look at is, do we want to leave the $30,000 in the operating company when the operating company could be prone to creditors or prone to legal suits? This is a problem for many corporations. What to do with the $30,000 every year that's accumulating inside of the corporation? Well, we know that we can create other structures by talking to a good tax lawyer, and they can set up what's called a holding corporation. And the holding corporation is actually where we transfer the $30,000 per year. And the holding corporation contains common non-voting shares of the operating corp. This, by Canadian tax law, allows the $30,000 to be transferred from the opco to the holdco as a tax-free dividend. So we get the $30,000 into the holding corporation, and lo and behold, that's where we set up the cash portfolio, the investments, and of course, in our case, the insurance policy, the participating whole life that sets up this strategy. If Jane also wants to pass on estate, some of her money to people like her grandchildren, and then perhaps her siblings or her parents, it might also be worthwhile to set up what's called a family trust or a discretionary trust. In this case, they would have common voting shares of the operating corporation. We'll talk about that reason in a moment. But the trustee could be dad and mom. It could be Jane and her husband, or it could just be Jane. It's totally up to whoever sets up the trust. Of course, the beneficiaries of the trust could be dad and mom, the children, the grandchildren, as I say, the siblings. Any blood relative essentially could be a beneficiary of a family trust. Again, monies that are flowed into the discretionary trust, they are also insulated from the creditors of the operating company. And we can indeed set up the same sort of par whole life insurance structure for the trust that we set up for the holding corporation. Once again, being able to house the money in a tax-efficient manner and make sure that it gets distributed in the same fashion. So this is a very strong structure for a successful corporation. It's a very tax-efficient structure. It's the kind of thing that any successful business should be considering when they look at trying to protect their income and assets. And so these are the areas of expertise that we have at NB Business Solutions. And this is one particular strategy that I find very valuable for those successful companies out there that will be, lifelong companies where people are going to work their business until they retire and then sell off the corporation. One last point, the reason that the discretionary trust has common voting shares of the operating corporation is quite simple. When the operating corporation is sold, the shareholders, i.e. Jane Doe, and perhaps her husband, we'll call him John Doe, they each receive an $800,000 capital gains exemption. This is important because the sale of a Canadian corporation involves a capital gain. If you sold your company for an amount above its adjusted cost base, then that additional money is taxed as a capital gain. So let's just say that Jane sold her company for $6 million. Well, if Jane and John were both shareholders, they would each be able to deduct $800,000 from the $5 million capital gain. The interesting thing is, because the discretionary trust is also a shareholder of the OpCo, then the children, the grandchildren, the siblings, or the grandparents, who all might be beneficiaries, can also implement their $800,000 capital gains exemption, of course, as long as they're 18 years or older. And in this way, you completely minimize the tax that is payable on the sale of the operating company. So to set this up, we need a tax lawyer. We need a tax accountant who can, of course, do the annual taxes for all three entities, or two of the entities. And my job, of course, is to maintain the cash portion inside of the tax-deferred structure of the power whole life policy, and to assist with other risk management products. So that is a simple scenario of a tax-efficient structure and a process by which we can, invest retained earnings inside of those structures. And that's all I have to say for today.
Sounds good. Well, thank you very much, Randy. That was a lot of information. Wow. So if someone wants to find out more about this and if they're interested in setting this up, how do they get a hold of you?
Well, Steve, my contact information is right here. I'm happy to answer cell phone calls or texts. I happily answer emails. And so it's great if someone's interested in this process. I, of course, work with qualified tax lawyers and tax accountants to properly set up these programs. I know sometimes accountants have difficulty understanding some of these concepts if they don't deal with them every day. They're sort of, it's a strange part of the Tax Act, and not all accountants are up on it. And so we do have specialists that we have that make sure these are set up correctly and can speak to business owners, accountants who are concerned about the strategy. So we have lots of resources in place to help folks make sure that they get these set up properly.
Yeah, that sounds great. All right. Well, thank you very much, Randy. That was very informative, very detailed. And until next time, thank you.
Thanks, Steve.